Welcome back to the Commercial Real Estate Show. I'm Michael Bull. Today we're talking about the U.S. office market. We have Walter Page here in Studio One with us with CoStar Portfolio Strategies. I'm used to calling it CoStar Group, right? Well, Walter, let's talk about the investment market. What did you see in 2014 for sales volume? It seems like it was pretty active in our shop. A lot of investors looking at the office market.
So, real estate office sales volumes totaled just over $100 billion in 2014. That's up about 5% from 2013. Now, that number will probably rise as more data comes in. The interesting thing about this is if you compare it to 2007, we had $140 billion. But in 2007, we also had a $39 billion single transaction, the sale of equity office, where I used to work. Now, if you exclude that sale, we are back to 2007 and 2006 levels of property sales without any ginormous property transactions such as an equity office. So clearly the capital is flowing to commercial real estate and in particular office. By the way, office is up more than any other property type in terms of sales volumes for the year.
So there's a bigger increase in office than anything else?
Yes.
Interesting.
So.
Well, what's attracting the investors to office? Is it the lack of new construction? Is it the job growth, or is it a combination?
It's a late cycle play. Office has longer lease terms than other property types, and people perceive that there's more upside in rents and occupancy for the office sector.
Well, that's interesting, and we're talking about people working at home and shrinking square footage per employee. And what you were telling us about Yahoo and what they're doing.
So Yahoo, the shrinking footprint is a trend that we see across the country, but in the case of Yahoo, they've said, you got to start working it instead of at home. You have to come into the office. So we do clearly see signs that shrinking footprint is probably the days are numbered.
Right. And then you see people that you didn't know worked there, right?
That's right.
That's interesting. Well, what about cap rates in 2014? So if the volume is picked up, I assume this cap rates, did they trend, they compress some more in 2014? Or?
Well, okay, so first thing, we're back to 2% 10-year Treasury rates. And cap rates sort of relate to the 10-year Treasury rate. For the most part, have seen very stable cap rates on a national basis. However, when you look at it, there is some compression, and the compression is occurring mainly in the second tier and tertiary markets. So, those primary markets like New York and San Francisco really were priced to perfection, and so that spread is narrowing between those.
Yeah, so that perfection was down to 4 and 5?
So the perfection, yes. The average cap rate on an institutional basis coming out of San Francisco and New York was in the 5% range, and we had some transactions that were, sub 4. Probably had some value add component or something like that to it, but exceptional.
Right, and then you're seeing the big value increases though in the secondary markets, and so you've seen a big cap rate change there. What would be an example?
So you take an Atlanta, you take Philadelphia, Phoenix, you can still get a 7 cap rate on institutional property, and we would look for that spread between the Atlantas and the New Yorks to continue to narrow over the next year.
Okay. Well, that bodes well to invest in these secondary markets. What are some other secondary markets where you expect to see cap rates improve? I guess improve if you're the owner. Decrease.
Well, I mean, the other way of getting the improvement is by doing a value add strategy. And so what you can do is you increase your NOI stream by either leasing up a property or leasing it up and fixing it such that you raise the rents and things like that. So what we are seeing is a number of investors actively soliciting these and reskinning buildings or putting new lobbies in, new bathrooms. And in this environment where we have declining vacancy rates and a flight to quality, they are also doing very well, and they're rewarded with excellent prices upon exit.
Yeah, that's a good point. We see that a good bit too, where we see people taking a B and bringing it more into an A status, or maybe when you guys maybe a 4-star to a 5-star, right? Increasing rents, but let's take that out of the equation and just look at stable properties. What do you expect cap rates to do in some of the various classes throughout the U.S. for office properties next year, especially in the light of maybe a slight uptick in interest rates?
Well, while there's this concern for a slight uptick in interest rates, when you look at the 10-year Treasury futures market, it's expected that we're going to be in a long-term period of low interest rates. The 10-year futures currently says that we're not going to go above 3 in the next 3 or 4 years. What that means is it's probably going to be pretty stable. So it's kind of be boring on the cap rate front.
I don't know. I'm over here doing the Snoopy dance. I don't think that's boring. We keep rates low. I think that's advantageous for at least brokers like us. They're out here doing transactions, right? So you expect volume to what do you expect volume to do next year?
So volume should be good. Okay. We had the likes of CalPERS announce that they're going to stop investing in hedge funds, and they're going to invest more in real estate. In fact, they're expecting to invest 27% more in real estate. And when you have billions of already, and you're going to add billions to that, that's real numbers. And we also see, relative to the world, the U.S. is a relatively cheap place in terms, or good returns and safer returns. And so we expect that this year we'll continue to have very solid investment volumes on the magnitude of what we've had over this past year, maybe even better.
One of the things that I like that you guys do, and you do a lot of great things, but one is the repeat sales index, right? What do you see there for office properties, for properties that are trading again?
So the repeat sales index hit a milestone. We're back to 2007 prices on a nationwide basis now. Now, obviously, in some markets, this varies. In San Francisco, prices are 50 to 70% over the 2007 prices. But in other markets where housing distress markets and things like that, they're still below. Over the past year, the repeat sales increased by 5%. The year before, it was 13%. So that clearly indicates that the cap rate trend is not compressing nearly as fast as what it was before from that data.
But still very healthy.
But healthy.
Walter, thanks for joining us today. We appreciate you being in Studio One.
Thank you.
And stay tuned. We're going to have more on the office market. We'll look at some tenant strategies and some landlord leasing strategies. Have a lot more for you. And be sure to catch a show of special interest to you. Sign up for a once-a-week email announcing the show topic at commercialrealestateshow.com. I'm Michael Bull. This is the Commercial Real Estate Show. We'll be right back. The Commercial Real Estate Show is brought to you by Bull Realty Commercial Advisors, a great place to do business. Visit bullrealty.com. RealNex, a comprehensive and powerful suite of commercial real estate tools at an incredibly low price. Visit realnex.com. That's RealNex. FIU, Florida International University. Earn your master's in real estate in as little as 10 months without interrupting your career. Visit FIUonline.com. Xceligent, the resource professionals use for commercial real estate information. Visit xceligent.com. That's XCELIGENT. Commercial Search, the source to market and source available properties for sale or lease. Visit commercialsearch.com. For more information on these great companies or for additional videos, podcasts, or articles, visit CREshow.com.